Have you ever wondered how large-scale industrial portfolios are reshaping the commercial real estate landscape? Today, we're diving into a major development in the industrial sector that might just answer that question. Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In a significant move within the industrial real estate market, Crow Holdings has wrapped up the recapitalization of a 6 million square foot industrial portfolio with Core Plus funds associated with Blackstone Real Estate. This deal, valued at $718 million, involved Newmark representing Crow Holdings. Under the transaction terms, Blackstone acquired a 95% stake in the portfolio, while Crow Holdings and its partners retained a 5% interest. The portfolio in question consists of 25 Class A infill buildings strategically located in the Dallas, Houston, and Chicago metropolitan areas. This transaction indicates a strong investor interest in well-located Class A logistics assets, as noted by Newmark's president and global head of industrial and logistics capital markets, Jack Fraker. Furthermore, Newmark Senior Managing Director Dom Espinosa highlighted the strengths of the industrial markets in these key metropolitan regions. While this deal reflects the robust industrial market in the United States, it also provides an interesting parallel to the industrial opportunities we see here in Ontario, particularly in regions like Kitchener-Waterloo, London, and Cambridge. These areas have been witnessing a growing demand for industrial spaces, driven by the need for logistics and distribution centers. As we observe such trends, it becomes apparent that cross-border insights into industrial growth can offer valuable perspectives for investors on both sides of the border. Legal counsel for Crow Holdings was provided by Fried Frank. This transaction is part of a series of strategic moves by Blackstone in the industrial sector, including recent sales and acquisitions in Los Angeles and Las Vegas, demonstrating the company's active role in reshaping the industrial real estate landscape. In a recent development within the multifamily investment market, 2 older apartment properties have been sold, signaling a warming trend in this sector. According to a report by Ben Vandermeer, the properties in question have been attracting investor interest due to their potential for redevelopment and value-add opportunities. These properties, located in a metropolitan area, offer a glimpse into the broader trends we're seeing in multifamily investments. With aging properties often being repositioned for modern amenities and improved tenant experiences, investors are keen to capitalize on these opportunities. This trend is not just limited to the United States. In Ontario, cities like Kitchener-Waterloo, London, and Cambridge are also seeing similar dynamics. Older apartment buildings in these areas are being considered for redevelopment, offering investors a chance to modernize and increase the value of their assets. Cross-border insights reveal that both Canadian and American markets are experiencing a shift towards revitalizing older multifamily properties. This is driven by the demand for updated living spaces that cater to modern needs, including energy efficiency and enhanced community amenities. H&R Real Estate Investment Trust, one of Canada's largest property owners, recently announced it has been in discussions with potential buyers following a hostile takeover offer. The Toronto-based company, which owns $10.5 billion worth of residential, industrial, retail, and office properties, formed a special committee of independent directors back in February to evaluate its strategic options. This move came after receiving an unsolicited expression of interest, as reported by Andrew Willis. Since February, H&R REIT has received several proposals regarding potential transactions, although it has not disclosed the identities of the interested parties or the proposed transaction prices. Despite this, the company's shares surged by 17.2% on Friday, closing at $12.46 on the Toronto Stock Exchange, giving H&R REIT a market capitalization of $3.5 billion. In its press release, H&R REIT emphasized that no decision has been made about proceeding with a potential transaction, and there's no guarantee that the ongoing process will result in a deal. The company has brought on investment banks and legal firms to advise the special committee and itself during this strategic review process. This development marks a significant moment for H&R REIT, which distinguishes itself from peers by holding a diversified portfolio across residential, industrial, retail, and office sectors. The analysts at RBC Capital Markets, Jimmy Shan and Pammy Beer, noted that while potential bidders might value the REIT at $14.50 per unit, the transaction could face challenges. These challenges include the likelihood that no single buyer would be interested in all the properties and the difficulty of underwriting office assets in a largely illiquid market. They suggested that competitive bidding could increase the chances of an acceptable offer emerging. In a broader market context, the discount between the trading prices of domestic real estate companies and the underlying value of their properties has led to several significant takeovers recently. Notably, Blackstone Inc. acquired Tricon Residential Inc., a Toronto-based apartment owner, for $3.5 billion United States dollars last year. Such transactions highlight the ongoing interest in and consolidation within the real estate sector, both in Canada and the United States. In a strategic move to control development and enhance community value, the city of Huntsville is actively purchasing land around the northern bypass. This initiative, known as land banking, allows municipalities to buy land to manage future development decisions. Shane Davis, Huntsville's Director of Urban and Economic Development, explained that this approach enables the city to determine who can buy the land and how it should be developed. One notable example of this strategy is the Food City property at the intersection of the Northern Bypass and Memorial Parkway. The city is keen on managing what gets developed at this key intersection, ensuring that it aligns with the community's interests and adds significant value to the neighborhood. Davis emphasized the importance of securing properties that can contribute positively to the community. He stated that the city would continue to market the property in ways that benefit the community, aiming for developments that enhance neighborhood value. The Northern Bypass project is on track for completion by late summer or early fall of the upcoming year. This development is part of Huntsville's broader strategy to guide urban growth and ensure that new projects contribute positively to the city's landscape. In a recent report by Nick Passion of the Puget Sound Business Journal, it's noted that Amazon's property values in Seattle have declined by nearly $500 million. This drop is part of a broader trend affecting Seattle's office market, which has been struggling recently. The report highlights that Amazon is not alone in this trend. 9 of Seattle's top 10 taxpayers also saw their property values fall last year. This decline in property values is indicative of the challenges facing the office market in Seattle, reflecting a shift in the demand for office space as companies adapt to new work environments post-pandemic. The trend of declining office property values is not exclusive to Seattle, as similar dynamics are observed in other major metropolitan areas. Looking at the Canadian market, particularly in regions like Kitchener-Waterloo, London, and Cambridge, Ontario, there is a contrasting demand for office spaces. While some areas have experienced a slowdown, others are witnessing a resurgence in office space interest due to the hybrid work models and the need for collaborative work environments. Cross-border insights indicate that the shift in office space demand is a global phenomenon, with companies reevaluating their real estate needs in response to changing work patterns. This presents both challenges and opportunities for investors looking to navigate the evolving landscape of commercial real estate. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.